Hello, everyone. Welcome to Context with Mike Del Prete. I'm your host, Mike Del Prete, and I am here today with my daughter, Allie. Hi, Allie.
Hi.
How's it going?
Pretty good, pretty good.
All right. You're doing all right? You drinking enough water?
Um, no comment.
All right. Well, make sure to keep drinking. It's important.
I will.
So, earlier today, I sent out a new article titled Industry Evolution Continues During a Receding Tide. And Allie is on my mailing list, and Allie likes to read some of my articles, and we thought we'd have a conversation about it. So, what did you think about the article this week, Allie?
I thought it was pretty good. It reminded me a lot of your presentation at Inman most recently.
How so?
You kind of discussed similar things. You mentioned the Netflix versus Blockbuster moment a couple of times in there, but you just kind of talked about how certain companies are like profiting and certain aren't, and I feel like you used some of the same graphs, so I knew more of what was happening.
And what do you find interesting about all that?
I just find interesting, like, specifically, there was a very particular thing. How you were saying that some companies are doing, like, in quarter two, you said that they were doing better, profitability-wise.
Mm-hmm.
But some of the companies might not have been doing as good substantially profitability-wise, but they were just, like, more stable in general, with structure, and I found that kind of interesting. It's kind of like if something's going, it made me think of, like, if you go really fast and then you burn and crash versus, like, taking the slow route. So, like, the rabbit versus the turtle or whatever the actual analogy is.
Tortoise and the hare.
There you go.
Slow and steady wins the race.
Yeah.
Versus going super, super fast, kind of like running a race, right? If you run a race and you just bolt out of the starting line and go as fast as you can, you might hit some problems.
Yeah, it's kind of like, the way I think about it graph-wise is like, it would be like a bell curve versus like just a linear growth that's slower. Like at some point, the linear line is going to take over.
Yeah. Awesome. All right. So what questions? Did you have any questions for me out of this?
Yeah, I did. My first question was on the first graph you use, it says H1 23. I know that Q1 is like the quarters. What's H1?
Yeah, no, that's a good question. The short answer is H1 means the first half. So there's half one or half two.
So like the first 6 months of the...
Yeah, okay. Exactly. It's kind of like this financial gobbledygook talk, right? Q1, Q2, Q3, and Q4 are the 4 quarters of a year.
Right.
And then you have two halves, H1 and H2, and then the whole thing rolls up to a year, or sometimes these companies call it a financial year, FY. FY 22 would be the financial year 2022.
I feel like we're in calculus.
Okay, good. Well, I'm glad we got that.
Yeah.
It's one of those things I don't even think about, but I really appreciate the question because anybody just has to understand the fundamentals, and I want everything that I'm working on to be super accessible. So
right.
Good one.
Okay. And then you also mentioned that you just kind of follow the agents to see where things are going. Just elaborate more on that. I kind of have my own interpretations, but I just want to hear what you have to say about that.
Well, what was the quote?
I don't know.
To identify the brokerage business models of the future, one simply needs to follow the agents. Is that what you meant?
Yeah.
So what's the question about that? Like, what did I mean?
Yeah, just kind of like elaborate more. Where are the agents going? Did you have any predictions? Were they kind of correct, or was there anything like an outlier anomalies?
Okay. No, it's good. So what I mean by that, to identify the brokerage business models of the future, you have to follow the agents, is that brokerages, if you distill it down, brokerages are just a collection of agents, right? A brokerage is like a holding company or an umbrella, and underneath it are agents. And the agents are the ones that are buying and selling, helping people buy and sell houses. So you can't have a brokerage without agents, and you can't have a brokerage doing business without agents. Really, at the end of the day, you just need the agents. So if you follow where agents are going, what companies they're working at, which companies they're leaving, which companies they're going to, that's a really powerful leading indicator. Like it's a clue, it's an idea of which brokerages, like the businesses, these are businesses that you and I can invest in, which ones might be growing,
Mm-hmm.
are going to be the ones that are attracting more and more agents.
Okay.
Does that make sense?
Yeah, that makes sense. And um, did you do that, or did you to like base your data off of? Were you like
Yeah.
looking at that and watching that, or was there like other things that you followed instead?
No, I was looking at that, and that agent, so that's called agent count.
Mm-hmm.
You can look at how many agents are working at these different brokerages. Like Compass will have this many agents, EXP has that many agents, Berkshire Hathaway Home Services has that many agents, and that's a number and it changes over time. Most of these companies report that on a quarterly basis.
Mm-hmm.
So you can see which numbers are going up and which are coming down. And it's something I've kept an eye on for years, but I think what's been really interesting over the past, I guess, past year, right, since the market changed,
Mm-hmm.
is the numbers are changing, but they're changing in such a way where there's a group of companies where the agent count is going up, and there's
Mm-hmm.
another group of companies where the agent count is going down. And there's some commonalities between that, right? There's a commonality between all the companies that are increasing the number of agents they have, and there's a commonality between the companies that are losing those agents. So what I mean, I'll ask you, like, what if we're looking at that and you say, oh my gosh, all of these companies are getting agents and all of these companies are losing agents, what could you learn from that?
Um, I mean, it's probably. Oh, I wanted to sound all fancy and use a word. I think you said it's like agent revenue or something, um, where it just kind of depends how much they make back per transaction.
Mm.
Um, and I remember you showing a graph. I don't think it's specifically on the article that you just posted, but there was a graph showing like um, different companies and how much they were paying back to their agents per transaction. And I think that there was a couple anomalies there that were like really high up there, almost 100%. And I think that just with that, I would assume that they have more agents because, I mean, at the end of the day, all the agents, we're all humans. We need to make money to survive. And so it's kind of just like, all right, this company is going to give me more, so I'll go over there. And it's
Mm.
just kind of like this natural draw to go over there.
Yeah, that's
Um,
exactly right. It's impressive you remembered that because that's exactly what it is. So the companies that are attracting agents right now
mm-hmm.
are the same companies that pay most of their revenue back to agents,
Right.
which is what you're talking about,
Uh-huh.
right? So that's interesting. That gets really interesting. So we can say, okay, in this period of time, in general, agents tend to be flocking towards those companies where they can make more money,
Mm-hmm.
right? To your point, we're humans, we want to make more money. Agents are entrepreneurs, they want to make more money. Well, they're going to those
Right.
companies.
But I mean, like, how long is that going to be profitable? Because if there's like, say, 10 companies and two of them are paying like, I don't know real numbers here, but like 90% payback, like, and everyone starts going there, well, then that's like a ton of money. I guess the agents are making money, but like, how long is that going to last? Are they going to like get overwhelmed or anything?
Who are the agents going to get overwhelmed
No,
or
the
the
brokerages.
brokerages?
Yeah.
Yeah, no, it depends. I mean, it's a good question about how quickly and how much can a brokerage grow. And some of these brokerages have been at this for years and years and years, like
Mm-hmm.
EXP, and they can't like you were saying before that curve, if it's a bell curve,
Right.
which it's not, but a bell curve doesn't go up forever,
Right.
right? There's a limit. There's only so many real estate agents, there's only so many transactions in the US. So
Yeah.
there's no answer, but that's the right question to be asking.
Okay.
That's good.
Well, that's interesting.
What else? Any other questions out of the article?
Um, yeah, another just quick definition thing. Low fee and legacy companies. Can you
Uh,
define that?
Yeah. So we were just talking about low fee brokerages,
Mm-hmm.
and that means low fee to the agent. So the fees that are charged to an agent are lower than normal, you know? So it might be 100% commission. Like the agent gets to keep 100% of their commission. They don't pay a percentage of it to the brokerage. It might just be
Right.
$150 per transaction per deal they do. So those are lower fees. If you're an agent, overall you're paying less money to your brokerage to be part of them. Lower fee.
Okay. Okay.
Does that make sense?
Yeah. So it's like lower fee in terms of um agent to brokerage.
Yep. Yep.
Okay.
Not to consumer.
Right. Okay.
Yeah. And then the legacy brokerages are these companies that have been around forever, right? You know, Remax, Keller
Mm-hmm.
Williams, uh yeah, Anywhere. which is Coldwell Banker and Sotheby's and all these other brands.
Right.
And that's
Okay.
more of the traditional real estate brokerage agent model, where it might be a 70-30 split or an 80-20 split, where the agent gets 70 or 80%, the brokerage gets that. That's kind of more of your standard model.
Mm-hmm.
And I put Compass. Compass is funny because they're kind of, they have a foot in both camps, but Compass has a legacy brokerage business model where they have those same splits.
Mm.
That's what it's called, a split, right? The 70
Yeah.
30,
Yeah.
80
Yeah.
20, 90 10. That's your commission split.
Okay. Yeah, I noticed that you talked about Compass a decent amount, and I was like, it's just kind of doing both things at the same time. I feel like it's kind of all over the place.
Yeah, I probably said it on stage at Inman. Compass is a legacy brokerage with the growth rate of one of the low fee brokerages.
Yeah, yeah, I think you did say that.
Yeah, I mean it's hard to, it's like talking about people. It's hard to define people. It's hard to judge a book by its cover.
Right.
There's a lot more nuance in this, especially when you get into certain companies that have a little bit here, a little bit there. But yeah, Compass is that outlier right in the middle where it goes back and forth.
Okay. Last question here, I think that I got is you were saying, I mentioned this earlier, but that legacy brokers have a better quarter two, but overall low fee brokerages are doing better, particularly structurally. What does this like hold for the future? Is this kind of like relating back to your like Netflix versus Blockbuster? And I mean, just how much, like, how's this gonna progress? Do you have any thoughts on that?
Good question. So what I mean by that structural advantage that the low fee brokers have is generally they have a lower cost basis. Like they have lower expenses than these other companies.
Uh-huh.
And expenses can be, I mean, what, for a company, what are some expenses of a company?
I mean, like technology, advertisements, paying for employees,
Yeah, all that stuff.
locations.
So the low, that's great. The low fee models have lower expenses. They might have smaller tech teams, less employees, less, they might have smaller offices or no offices. Like eXp
Mhm.
Realty, they don't have any offices. It's all in the cloud. It's like a metaverse virtual world. That's where their employees meet and where they have meetings and stuff.
Is this since the pandemic or was
No,
this
it was
before?
it. They've been doing that for like 10 years before.
Oh, wow.
Before it was cool, yeah. So that's where the structural advantage is, because in a time like today, when there's a lot less real estate transactions, so there's less deals being done, being nimble and lightweight and agile is, you're going to have more runway. You're going to have more ability to do things, right? As opposed to
Right.
like a big company with big expensive offices and thousands of employees. That company's going to have to slash and burn and cut and just try to trim their expenses just to survive. Whereas these lower fee models that are much lighter operationally, they're kind of nimble. They're ready
Yeah.
to go and they can invest in the business.
Okay, yeah, no, that makes sense.
But that's where we are now. It's a down market, right? Things
Right.
change. If you get more and more transactions, I was just emailing somebody today, and they were saying, hey, but these, the legacy brokers, they will be more profitable. They will make more money in an up market where there's more transactions. And
I feel like-
that's true.
Yeah, it's a lot of just like this could be, it might be, but it's like at the end of the day, this is what is happening, you know?
That's great. Who knows what's going to happen? But right now, this is what's happening.
Yeah.
And if you go back actually a couple years, the clear trend around agents, just to go back to where we started, which companies agents are going to, that's actually been the same. The companies that are growing exponentially, what
Right.
exponentially means, right?
Yes, yes.
Super fast.
Yeah.
Those are these low fee models. So in general, no matter what the market is, they're attracting agents. And yeah, you know what? If you have agents, they're going to do transactions, and that's generally a good place to be, right? You want to,
Right.
if you want to invest in a company, you want to invest in a company that's growing, it's recruiting agents, it's doing more and more deals. At the end of the day, they'll kind of figure out profitability for themselves.
Yeah, no, that makes sense. I feel like frequently you get asked like, what's happening now? What's new? What's going to be happening? And it's like all the time it's kind of like, well, we could think about what's happening, what's going to happen, right? And it's like, well, I don't know what's going to happen. It's kind of like we have what's happening now
Yeah.
and what happened.
And that's interesting, because if you plot that out, right? If you plot out what's happened up
Mhm.
to now, that's going to give you like a trajectory,
Yeah.
right? If you plot a bunch of dots and they're all going up, you can assume that in the future they will, like it's likely they will keep going up.
Yeah.
Or if things are flat up to now, like some of these legacy brokerages, they're not growing, they're just flat.
Right.
You could make a good guess, an assumption that, well, they'll probably keep going flat, or maybe they'll go up
Mhm.
or a little or down a little bit.
Right.
So yeah, just plotting stuff out over time is really helpful, but you're right, nobody knows what's going to happen in the future.
Yeah.
Well, this was fun. Thanks for joining me today.
Yeah, it was really fun.
All right. And yeah, so that was talking about some analysis from today. This was Context with Mike Del Prete. You can find more of my podcasts and research and all this stuff on my website. That's mikedp.com, mikedp.com. All right, we'll catch you later. Thank you.